All right. Welcome. Welcome. I see folks have joined. I'm sure others will be joining in the next moment, but I just wanted to go ahead and welcome everyone and be timely, as I know that everyone's evening is busy. So this is very much something that was inspired by our efforts recently at learning about real estate and explaining deals to our investors. There's so much terminology. And so let me begin with an introduction. Thank you for being here. Thank you for this webinar that we're putting together here at Apex Multifamily Capital LLC. And the goal is to really start trying to put together a series of webinars and information to explain the language of multifamily and to really explain the lingo that is used so that when you, as an investor, wants to invest in real estate deals, how can you go ahead and take a look at the deal and understand the terms? Do not worry about taking notes. At the end of this presentation, we will share the replay as well as the slides with everyone that signed up. I think the goal is just to start introducing these terms and just getting folks familiar with them so that you can become a very astute person evaluating deals. So let me start by saying that this disclaimer is by no means exhaustive, but at least puts forth that we at Apex Multifamily Capital are not financial advisors, nor are we tax professionals or accountants. So before you make any investments into real estate, be sure to consult your own financial advisor or tax professional and really understand your unique tax situation and the implications of investing in real estate, whether it's with us or anyone else in multifamily or otherwise. With that out of the way, let's talk about what we are going to cover today. So first, we will provide a brief overview of multifamily real estate investing. Then I want to speak a little bit about the most common terms used in real estate, the critical aspects to think about when selecting a deal, and what you should expect from your sponsorship team or deal team. But before we dive in, now that I see that more folks are on, I just want to take a moment to introduce myself. My name is Ayeha Khalid. I am an ear, nose, and throat physician. Recently, in the last year, have gotten very engaged in the multifamily real estate community. And at Apex Multifamily Capital, we look to work with amazing syndication teams. I really have enjoyed my friends and colleagues in the multifamily mindset community, and shout out to Ann Santos at Cobalt Capital, who is on this call as well, and we have done some webinars together. Our goal, though, is not to tell you about the deals that Apex has done, nor is it to tell you about other deals that we have going on right now. This is really a business conversation to pack in as much information as we can for you to learn. And obviously, happy to answer any questions. Feel free to reach out. Contact information will be at the end. So first, let's define multifamily real estate investing. Multi just means plural. It can be anything as small as 4 units, 5 units, 20 units, 2,000 units. So if you say, I am a multifamily real estate investor, what does that mean? Well, I can tell you that one principle that I've learned and we really abide by is, in some ways, as you expand the number of units, you lessen the risk with any particular unit. So take, for example, someone says, I'm going to go ahead and be a multifamily real estate investor, and I will have a 6-unit apartment building. Well, if any one of those apartments is not occupied for several months to a year, that really increases the risk and the loss that you're experiencing financially. That being said, I would not want you leaving this presentation or early in your career saying, I think we can take on a 2,000 unit investment as a team, because I think such large amounts of units also come with an entire property management and asset management. So if you can increase the rent 10%, and we'll talk about terms such as forced appreciation later, That is obviously going to mean more in something where you have 2,000 units with your team of investors versus if you can increase the rent 10% and you only have 20 units. But again, let's take all of that with a grain of salt. What I want you to leave here with this slide today is that one of the things that I've learned along the way is when your apartment complexes have greater than 20 units and you're working with a team or a syndicate as we do, there are some serious advantages in terms of the loans from the lender. So what I wrote at the bottom is that if you are a passive investor in a deal with, for example, a 200-unit investment, you're not personally taking that loan out as a liability, whereas you may be doing that with a single-family flip or a smaller multifamily complex. It doesn't mean that you should not do that. It just means that if there are ways for you to invest your income while decreasing your liability, multifamily investing might be for you. But the second thing that it shows, and I often discuss this with investors, is that it shows you that the sponsorship team on the deal, especially the sponsors in whose name the loan is in, are really taking this seriously. And the success of your investment is even more important to them than it may be to you. And I think that is something that is really important to consider. What is the equity and the risk that the GP team or the general partners are taking on? The next term, and like I said, we're flying by these terms, so I'll send over these slides and we can always go over this again. The next term is cap rate or capitalization rate. This is a hot one and one that you'll see on all the deal portfolios and offering memorandums that you are taking a look at. And with each of these, I want to define the term and then give you an example and an explanation. So for cap rate, it's the measure of the potential return on an investment. And what that really means is, and I'll show you this even further in the next slide, is that NOI, remember that as net operating income, is divided by the current market value. So for example, using simple math, if we are looking at a $100,000 NOI with a $1 million value, that's a 10% cap rate. What I want you to walk away from, even more important than that calculation, is the averages. And when you, as a passive investor, should be savvy to let your alarm bells go off that this deal may be a little bit riskier. It may be for you, depending on your risk tolerance. So the average cap rates, as stated here, are between 4 to 10%. Think of it this way. As those cap rates climb, so does the risk. A cap rate above 7% may be perceived as a riskier investment. One below 5 may be seen a lot safer. It all depends on your personal risk tolerance. Now remember, underneath cap rate, there's a bunch of multiple factors, including the interest rate. And for those of you that are mathematically inclined, we can always walk you through the numbers that went into the cap rate for that particular deal. But I want you to leave with tips so that you can look at any deal. So let's move to the next term. The next term is another one that's hot and in all the deals and thrown around in multifamily real estate, and that is net operating income. So this one is really important. This is the total income after your operating expenses. It means that it includes your rental income and it subtracts your operating expenses. That sounds simple, but having been involved in a few deals recently on the GP side or on the side that's managing the property, really doing a good job of increasing your rental income and slowly shrinking your operating expenses with property management that is excellent can make a very big difference in your NOI. So let's take that a little bit further. Real estate investors should definitely look at the NOI when you're looking at the property's value and when you're thinking about the return on investment. In general, a higher NOI is a more profitable property because you're going to get more income back. However, as we often discuss with investors, You have to start somewhere. And then in our model, as we're building the value or holding on to the property and then selling it, you have to end somewhere. So you may not start with the NOI that you desire, but the question is, how can you get very granular on the expenses as well as boost the rental income with value-add amenities in order to boost that NOI? So again, net operating income is key and visited by the team over and over throughout the time period that you're holding on to the property. Everybody loves cash flow. I put this picture of money in there and said, multifamily real estate investing is about cash flow. The question is, when are you getting that cash flow? So the cash flow really, I mean, the definition in any case is the money left after all the expenses are paid. And obviously there's positive cash flow and negative cash flow. You have to think about how much income is coming in with your rental income or your amenities that are being used, and then think about how much money you're spending. But there's more to it than that. There's accounting. And as you think about your balance sheet and what your end of year balances look like, the expenses are recorded when you incur them and not necessarily when you pay them out. And this is no different than the business world. So as you, as a passive investor, are vetting deals, you may really want to see what that substantial expense was recorded last year. When does it have to get paid out? I.e., there were some expenses that we know were coming, something needed to be fixed, for example. The question becomes, has that already been paid out or not before you acquire the property? And these are all the things that we at Apex Multifamily Capital, as well as the teams we work with, really try to explain when you're coming on to the deal, because this would have been part of our underwriting process. On the other side of the debt that we started to discuss and the loan that the sponsor's taking out, now let's talk about the good stuff, equity. So equity is defined as the value of your ownership interest. Think of it this way. What is the market value of the apartment building minus the mortgage balance? That sounds simplified, but we'll break that down further. So start with the fact that if something is worth $500,000 and there's $300,000 that is taken on as a loan from the bank or a mortgage, then that leaves you with $200,000 of equity. This may seem simple, but let's take this a step forward. In real estate, a property is considered an asset. And liabilities are not just the loans, but they're any fines or debts associated with the asset, like the one I mentioned, might have to be paid out to fix something. So the total value of the asset minus the liability is what's going to give us the total equity. Now, why does this matter? Because as we'll go through this presentation, one of the hallmarks of multifamily real estate investing, especially when done well and successfully, you want to force the appreciation to raise the equity side. So in an ideal scenario, you often want some great debt financing with either an assumed loan that has low interest or a loan that can be refinanced with an agency loan, which is one of the deals that we're looking at right now. But that being said, once that debt portion is fixed and decided in terms of strategy with the team at acquisition, all of the value that you're creating in the building is raising the market value and therefore raising your equity as an investor. Let's keep going. We've talked about this word, appreciation. Appreciation is really an increase in property value over time. Depends on market conditions, depends on property improvements, but as we always share with our investors, appreciation in an apartment building is often very different than appreciation in your personal home. You may make some repairs in your personal home, and that value of a single family or a duplex may go up a certain amount dependent on the market, dependent on the neighborhood. But that being said, the appreciation of an apartment building or an apartment complex, as we're talking about here, has to do a lot with multiple factors. Number one, I want us to go back to NOI, net operating income. Are we forcing appreciation by being able to have designed a better building, a better place to live, a more beautifully appreciated residence for the tenants? And if so, we're forcing appreciation as the rents slowly go up over time. But second, there's other things. When you're looking for an investment as a passive investor in multifamily real estate, you really want to go back to that hallmark saying, location, location, location. Where is the apartment building located and in what city? And if we remove our emotions from it, it's not a city that you particularly might love because of a restaurant. It should be a city that people are moving to. There's job opportunities. There's rental demand. What is the development in the area? Those are all the factors that we take in at Apex Multifamily Capital as we're thinking about folks that we're doing deals with. So think about appreciation as perhaps not just what is happening inside your building, but also what is happening in the landscape around it. Debt to income ratio. I warn you guys, this is a very nerdy presentation to get through terms. Well, we're more than halfway there. So the debt to income ratio is really your monthly debt payments versus your gross monthly income. And this is often used, for example, if we look at our, personal credit scores and you log in. But in the case of multifamily real estate, it becomes important for a different reason. The example I used is if you have $3,000 of debt and $10,000 of income every month, then your debt to income ratio is 30%. Simple enough. However, when you, as an evaluator of real estate investment deals, are thinking about where to passively invest, you should know that syndicates and teams with track records of success are able to secure better debt financing, have larger real estate portfolios, may be able to find off-market deals with assumable debt that still has a low interest rate on it. And more importantly, and it's a little bit beyond our presentation today, some of the deals may have a debt that you take on at the time of the deal start, for example, one that we're involved in right now, but we know that we can refinance with agency debt when the deal hits certain metrics, and that can mitigate your risks even further. So the debt to income ratio is important. I don't want any of you to get hung up on it, but I want you to be aware of what that percentage is and not have that percentage too high. Similarly, the loan to value ratio. So again, I wrote here, there's a delicate balance between debt financing and equity in the property. For example, as many others have stated in presentations, there is an art to leveraging the bank's money to make money in a real estate deal. But in a high interest rate market, that can be very tricky. So I tried to put here some rules of thumb that we can provide. Think of it this way. A higher loan to value basically indicates a higher risk. So those two are proportional. If you see something within the range of 60 to 75%, lower is even better, then you know that that's a good deal. Once you hit 75% or greater, 80%, those may be deals as an initial investor that you may want to avoid. But of course, this depends on your risk tolerance and your appetite. Gross rent multiplier. So this is the measure of potential profitability. And this is a really important one. I want everyone to really think about how important this might be. If we take the purchase price of the property and I divide that by the annual gross rental income, that is going to give a ratio. So for example, if a building costs $600,000 and you divide that by $60,000 of rental income, that gives you a GRM of 10. Why does that matter? Often, this is a screening metric that your team should have looked at to compare the property of interest to purchase to the neighboring properties. So typically, on average, you want to be able to get a gross rent multiplier between 4 to 7. If, for example, in the example provided here, you're seeing a gross rent multiplier that is 10 or even higher, the question becomes, are you paying too much to purchase this property? Should you go back to the seller with that analysis and say, you know what, I need this GRM to come down? In order to do that, you have to have a good idea of what your GRM of the building is. And we often use industry reports to then look at what the rental income is of neighboring properties and what their purchase price was. Occupancy rate. We're in the home stretch. Occupancy rate is really the definition of percentage of rented units. This seems pretty obvious. Unbelievably, though, this is a source of consternation for all of us involved in looking at deals, looking at apartment buildings that we want to acquire, and most importantly, thinking about what that ramp up is to occupancy for apartment buildings that we then want to sell. And really, when you acquire an apartment building, you want the occupancy rate to be decently high, but you need some room to increase it as well. So for example, ideal target 95% occupancy rate on average will be excellent to have achieved prior to sale. And again, it's a little bit beyond what we need to do today, but think about the fact that you want to have your apartment building occupied for not just 1 or 2 months prior to selling it. You want that T12 or 12 months of occupancy that shows a high rate, and that will matter, and buyers will look at that. So how do you do that? You don't just boost occupancy rates by lowering the rent or providing concessions, which is often, as we see now in today's economic climate, what many owners are doing. You may need to do that if you're in an area with a big shortfall. But that being said, you really have to customize the experience. People have to want to live in your apartment building and stay in your apartment building. And many people think that doing real estate is simply about what it looks like or how many bathrooms are in the apartment. And while that matters, there is this feeling that people want to be proud and happy of where they live. And so we spend a lot of time thinking about the ambiance, the amenities, the oasis that we're working on with the property down in Jacksonville to really think about, how people feel about living somewhere. CapEx. This was a fundamental learning for me when I started. When we started at Apex, figuring out that you can separately raise in a multifamily deal by pre-planning all of the necessary long-term improvements that you will need, the funds for acquiring whatever it is you want to put in. Example, new HVAC system, new windows, adding amenities such as a dog park, all the things we just talked about why people want to live somewhere. The key is planning ahead, underwriting that very carefully and conservatively, and raising those funds up front. And why does this matter? Because as we've had conversations with investors, you don't want to be coming back to your investors every few months or every year and say, by the way, we forgot that we had to do XYZ, we're going to need more money. And I think it's very reasonable for you as an investor to ask, what is your CapEx budget? What are the improvements that you're planning to make? And to what percentage of the overall units are you planning to make them? And if your team can answer those questions cogently and show you that math, it at least then reassures you, because remember, the goal of this presentation is you're trying to be able to screen deals anywhere that you find them and understand, is this a good deal or do my alarm bells go off? So cash on cash return. The next two are extremely, extremely important, and not just because they have the word cash here. So cash on cash return is really defined as the annual return on the cash invested. And this is a key metric to consider because the cash on cash provides you, I think of it as a snapshot of your annual return, whereas ROI, a term that many investors often ask us, is really the return on investment, which is cumulative. So obviously, when you're looking at a real estate deal, the higher the cash on cash return, the better. That being said, what is that higher cash on cash return asking of you in terms of risk? So balancing that, getting a 10% cash on cash or higher would be wonderful, but at what cost, at what risk? And that is the two things that you have to balance. Internal rate of return. So this is a very, very important metric, just like cash on cash. I would say this is one of the metrics definitely as you're perusing a deal you're looking at. This is an estimate of the deal team telling you how profitable this investment will be. Look at all the words I wrote here. Let's distill that down. If the explanation of this is the discount rate that makes your net present value of the cash flow zero, what does that really mean? What it means is the internal rate of return is the rate needed to convert the sum of all the uneven cash flows that you're going to have in this deal to really figure out what the break-even point is. So at the end of the day, it is taking things that will ebb and flow. Example, you take on a multifamily deal where you're planning to do value adds, and the cash flows back may not be as large initially, but then increase in the first or second years. And then a few years down the run, you're selling the property and you'll have the proceeds from the sale. So there'll be an ebb and flow. What you really need to do in financial accounting is then make that at a discount rate that makes sense so that you can compare it to other deals. So a 12% internal rate of return indicates that you're expecting a 12% annual return. It may not be the case. Sometimes the IRR can get so sexy for people that it becomes the only metric that sways their decision. So I wrote here, it should not be the only metric that sways you, but it is definitely one of the 3 or 4. So remember, net operating income was definitely there as well. Cash on cash return was there as well. And for us at Apex Multifamily Capital, internal rate of return is there as well. Average investments can range from 15 to 20%. But again, it depends on location, depends on investment strategy, and it depends on the deal structure. So how does one compare internal rate of return with annual rate of return? Annual rate of return, I think of it as if your mind is exploding as you're looking at the IRR break-even points and thinking about all the factors that go into it, annualized return becomes a way to just take something that ebbs and flows over time and calculate it into a yearly rate. And in some ways, financial accounting would argue that this is a simpler representation of returns, but again, it allows for a conversation. I can say to someone, this is commonly what you will expect yearly. The investment of $100,000 will grow to $160,000 in 3 years. That suddenly becomes something that you can put your mind around. Fair market value. I would say this is another term, just like internal rate of return, just like net operating income. Fair market value matters. Why does it matter? Because this is the price you will sell your apartment building for in the future as a passive investor with your deal team. This is going to be based on NOI, which you're all experts in now, so net operating income, times 10. So, for example, there's different ways to calculate the fair market value as shown here, but let's leave it as follows. When you own a home, the fair market value of your home may appreciate in your personal home, both with what you're doing inside of the house, but is also very much dependent on the neighbors' prices of how much the other homes around you are selling for. Whereas the value of your apartment building deal as a passive investor is to some degree dependent on the city and location and what the job market is doing and what the rental demand is, there are such good ways to boost the fair market value of your building, even as compared to the buildings around you. Because the fair market value of the building is dependent on NOI. And we all remember that NOI is income over expenses. So if we can boost our rental income and shrink those expenses that we're subtracting, income minus expenses, then we're able to really boost and multiply by 10 that fair market value when we're selling the building. And this you will see in deals, and I think as an investor, it's important to keep track of. So what kind of properties should you invest in? So let's end with this definition and we'll wrap up. Properties are classified by age, location, condition, but one common classification as shown here is A, B, C, and D. A would be, I live in the Boston area. It would be the seaport, just the gorgeous buildings by the waterfront. But lately, it's also new constructions that may be happening in Boston, in Florida, and Texas, and we'll talk about that. And D would be, you have to improve the entire neighborhood. It's such a distressed area that it's difficult, even with creating that, residential experience, you'll be able to improve rents. B and C fall in the middle. I will tell you that at Apex Multifamily Capital, B and C properties have been the core of our investments thus far and investments we've brought. But there is something important to consider, which is one of the reasons why we thought this webinar would be important now and timely. The current climate suggests that there will be a shortfall of new construction available in the next 5 to 7 years. There have been, of recent, many properties that have decreased their rents or provided concessions in an effort to fill the building with occupancy. There has also been, with the way that the economics are going, the political climate is going, there's not been as much of a planning of new construction starts or construction finishes, but that is in stark contrast to the fact that many companies are moving to different cities, to the Midwest, to the South, and they're bringing with them young employees that are looking to rent. So in order to build that, rental demand and really fill that, we have started looking at Class A properties to really look for great returns on a new build. Which property type should you invest in? That's a personal decision. But I think the most important point here is to just know that these categories exist and be able to ask as an investor, what class property is this? What class neighborhood is this? And then put those two together. And we covered this, but just to remind you, what are the aspects of selecting a deal? First, trusting the team and engaging with people who understand how hard you have worked to earn your money and how smartly you want to invest it to diversify. Market. I think this one is really important. When a market is perceived as hot and the best deals are in that location, the issue is many times your time for investing in that market might have just passed because everybody else knew that market was hot and has already been investing. So you have to balance what seems like a really hot market that everyone's talking about and really be looking for the markets that are up and coming. Risks. Be sure to ask. Never be shy as an investor or feel time pressed. What could go wrong? What are the downsides of the deal? Have you accounted for insurance? We're currently looking at a deal in Florida, and we know that people will ask about hurricanes and insurance, and all of that has been factored into the underwriting. And finally, transparency. You want transparency of the numbers, you want transparency of the risks, and you want an investment team that will update you as it progresses. What should you expect from a sponsor? Again, similar, right? Trust is key. Frequent communication. Honestly, when we engage with investors, it isn't really about whether you're going to invest in a deal that we're on. It's about understanding what investments make the most sense for you. And so you should definitely be investing in real estate with someone you're willing to build a long-term relationship with. I can tell you that we personally feel married to the properties that we have invested in for the duration of that hold and probably after. So this is a long game. This is not a quick get-rich business. It can be. Sometimes the time frame is short, but you do have to have patience. If you want any more information, please feel free to go to our website and or reach out, ask any questions. I want to thank everyone for attending and joining. And also, if you have any questions, please go ahead and put it in the chat. Thank you all for attending, and we at Apex Multifamily Capital, thank you.